it speaks to heading into 2026 with an open mind about seeing a recession and bear market as we head for those 4-year cycle lows across the board. Despite the fact that inflation is clearly under control, okay, and despite the fact the labour market is clearly deteriorating, the CME is currently still pricing in a pause in the late January FOMC meeting. Now, I make the case that this thing is going to reprice this way as soon as the yields finish their backup, okay, and that's because just tell that to the bond market. It doesn't matter what anyone thinks, says, or does pertaining to rates, okay, because it's the bond market in aggregate that sets rates, and once the yields are finished their backup and continue to move to the downside, this thing will reprice this way, and I think we will indeed be seeing a 25 basis point cut in January's meeting. For me, this gets even more interesting, okay, because we have now reached the 3-month window where if we really are cutting into a slowdown, which I believe we are based on the inflation and the labour market data, and based on the fact that we've got yield curve inversion occurring with this set of rate cuts, which you typically don't see when we're cutting into normalization and a soft landing, it should soon be time to start to see the risk on assets performing like they are in bear markets.